Good morning, everybody. Welcome to the Flow Show. Here we are, Thursday, the 2nd of October. Hope you're doing well today. I'm just scribbling down some last-minute headlines that have been coming through. So that's a delay this morning, just by a few seconds. Anyway, here now, just keep an eye on some of the price moves going on as well. Dollar yen getting it in the backside. Getting a real kick in that one there. Right, let's get into the headlines, and then we can look at the prices and what's going on. Not a lot anywhere else, though. Going to start with Japan, and Japan are going to convene an extraordinary Diet session on October the 15th, according to Yomiuri. I don't know what that's about. It could well be related to whoever is the new leader in Japan. Could be their first parliamentary session. So we'll wait and see what that happens. I don't know if it's going to be anything to do with elections or possible elections, but that's what's going to happen anyway. Over at the BOJ, Deputy Governor Uchida says that Japan's economy is recovering moderately, albeit with some weak signs. Says overall business sentiment is at a favourable level, and that the Tenkan report showed business sentiment is positive overall as the uncertainty over US tariffs recedes. And he says capex is rising moderately as a trend, and consumption is moving on a firm note, and they will raise rates if the economic outlook is realised. Then says we'll judge without any preset idea whether our economic price forecasts materialise. This is underlying inflation likely to stagnate for some period before re-accelerating gradually as inflation expectations heighten. Now, inflation stagnating, if that's at current levels, would be well above 2%, which is what they want, stable inflation above that level. But anyway, this is another Bank of Japan member looking like he's shifting over the line between staying on hold and moving towards a hike. So we really are looking again to potentially get a hike in the next few meetings, perhaps as early as the one at the end of October. Who knows? We'll get a further idea, no doubt, via sources pieces leading up to that. But it is a possibility. I think at least the next three meetings are going to be live if things continue as they are. Over at the Bank of England, and BOE's man has been on the offensive all week. Adding to all her prior comments, saying that she worries more about inflation expectations than the labour market, and that most recent market moves over the summer were UK made. Says she prefers a longer hold on rates, so giving a little bit of a warning perhaps to the powers that be, that some of these market moves aren't just following what's happening globally. They are of the UK's making. We had a survey that's run by the Bank of England, the decision makers panel, saying that 1 year inflation expectations are up to 3.5% from a prior 3.4%. We've had another less strong looking auction for 2035 bonds. There was a bid to cover of 2.78 versus 3.33 prior. So interest is waning a bit more in one of these auctions. To try and stoke up some activity in the UK, the London Stock Exchange, apparently the UK is going to exempt newly listed company shares from stamp duty tax. That's according to the FT. Our listing market, if we call it that, has been suffering a bit of late. They're trying to get that ball rolling again. So it's something that is going to probably come up in the budget as well. Over in the EU, apparently they just popped up on the wires. They're going to propose doubling the tariff rate on steel imports to 50%. Not seen any details over who, what, and where for those, but that's what they're saying for that one anyway. Right, let's go and have a look at yesterday's data. I've not even got my calendar set up yet. Look at that. Bingo, bango. So the big data yesterday was obviously that ADP number, which dropped while we were on face, and it was a bit of a wobbler, coming in at minus 32,000 versus a 52k expected. Also, the prior number of 54,000, up 54,000, was revised to down 3,000. Now, there was some shenanigans here. Firstly, it was late dropping, which got everyone anxious. It took, I think, a good 4 minutes before I actually dropped. And then there's a lot of bits and pieces in there. Apparently, there was some benchmark revisions, a bit like what the BLS did to the NFP numbers with that minus 911 revision. So apparently, there was some 43,000 jobs re-revised in that, which led to some of that negativity. So, long story short, it was a complete mess. The market saw the numbers and just whacked the dollar. First instinct was to give the dollar a whack, and whacked it did. Then it did recover a bit after that. There were only 3 sectors that posted jobs gains, and the biggest drop in jobs in area-wise was in the Midwest area. They lost something like 67,000 jobs in that area, which could be migrant labour related. Obviously, the Midwest is a big farming area, lots of migrant labour in that, so that could be. That was just a thought I had. It's not conclusive, but that was just a 2 + 2 could equal 5, could equal 4, could equal 9. Who knows? But anyway, that was a big area that saw the bulk of job losses. As you could imagine from that data, rate cut expectations rose, firmed further, should we say. So the 2-cut basis that the market's looking at was a bit firmer after that data. Then we got the PMIs. Firstly, we got the final S&P global PMI, which was unchanged at 52, and just confirming the dip down from 53 the prior month. And then the ISM, which was a little bit meh. I mean, we know this data is now going to become important because we're not going to get any government data, but we know what manufacturers been doing. It's been in the doldrums for pretty much 2 years, if not longer. And things hadn't improved much at all there. The headline number did go up by 4 pips to 49.1, still in contraction. Prices came down, not hugely, 61.9 from 63.7 previously. And employment went up a few points to 45.3 from 43.8. Still in contraction though, but less crappy than it was before. It's the services data tomorrow, the ISM services, that's going to be the big one, particularly in place of the NFP. So those employment numbers and prices numbers are going to be bigger movers than this one will be. But at least we get an idea how the market's going to be looking at this data. If it probably the biggest move we've ever seen on the ADP yesterday, and this is all the market's going to have to trade off now moving forward. On the shutdown stuff, it looks like we're not going to get anything done until at least next week. House Speaker Johnson says there's nothing we can do to make the stopgap bill better for Democrats. There's nothing for me to give or to negotiate, and the House will be returning next week. One of the reasons why we might not get any faster conclusions is because of the Jewish holidays over now and the weekend. So a lot of politicians will be out, so they will be returning. The House will be returning next week. VP Vance says they've not made any final decisions on firing any workers during the shutdown, though Axios reported that apparently the White House is going to begin firing federal workers within a day or two. So it could come before the end of the week that we know what they're going to do on that side. Fitch was out and about saying the government shutdown does not have any near-term implications for US's rating, but says the prolonged government shutdown could strain public finance credits and obviously be a bit of a drag on the economy as well. Fed's Cook is off the cards until Christmas, well, till the new year, because the Supreme Court has refused to let Trump immediately fire her, so she gets a potential stay of execution. It's going to hear arguments in January, so she's in play all the way through to the new year. Trump says he'll be meeting with China's Xi in 4 weeks, and soybeans will be a major topic of discussion. The reason being, there's reports that China hasn't bought a single bean, and in fact, to get most of his stuff from Argentina, a lot of stuff from Argentina. So Trump wants to drag up the old soybean deal that was one of his big things in his first term, that China still didn't adhere to, even getting when they had a deal on it. So 4 weeks anyway, he's going to be speaking to Xi apparently, and we'll play the old what time's a phone call game again. The Kremlin seem a little rattled over all these proposals to give their frozen money to Ukraine. They said on the European proposals, this is pure theft, saying those who steal our assets, both individuals and countries, will be prosecuted and held accountable. Destroying trust in private property by stealing Russian money will be a boomerang that will hit European depositories and investment. They also commented on US's Hesketh, saying that the US should prepare for war to ensure peace, saying that they would also prefer to strengthen our armed forces for peace. Following that, there's been reports that Russia has already been drafting plans to seize foreign assets in the event of the EU acting on frozen funds. So again, we're still in a situation where, things are ramping up slowly in terms of what Russia or what the West does with all this frozen money, or trying to push Russia into at least peace talks, which they're still refusing to do. Although Russian Deputy Foreign Minister said the next round of Russia-US talks are going to take place by the end of autumn. So that's still quite a ways away. EU's VDL says that they have a sound legal way on Russian frozen assets. So they'll have to follow certain legalities to be able to use that money. Not that Russia will give a monkeys either way. Sweden weighing in too. Their PM says very much in favour of a more offensive way of using frozen Russian assets. So if the EU goes ahead and uses frozen Russian assets to fund Ukraine, that will go down like a lead balloon. And again, it will be another step up in potential threats, shall we say, what Russia does in retaliation to that. So we are building up, as I say, slowly and slowly, we get into a head on this stuff as the West take further actions to try and get him around the table. And that's it on the headline front. Not a lot. We're seeing fairly calm markets in between when we're getting headlines and stuff. Like just mentioned, we get seeing dollar yen moving off quite sharply. Oh, let me get into this. We are seeing volatility creeping down a bit. I look at the 1 month foals. Let me just get those up for you so I can show you what we're looking at. Give me 2 seconds. So this is on our platform. You can see we've got this handy widget in here. So these 1 month foals is what I look at. The rough pivot point for when it's getting quiet and when we've got decent vol is 6 to 7%. Below 6%, things are getting quiet and we're seeing tight moves, and even around data points, we're not getting much moves. Above 7%, we're keeping some fairly sharp moves, particularly over data and stuff. So we're sort of bang in the middle of that sort of neutral range. Dollar yen is obviously a bit higher, has been higher for a while, hence why you're seeing still bigger moves when things happen, as just mentioned, but these vols are coming down a bit. But if we've got all these risk events going on, then they shouldn't drop too far. If we're getting down to 5%, 4%, you're going to see some real dead markets. So let's keep our fingers crossed we don't get down there. So just talking about dollar yen, we're having a little crunch now. We now look like we're going to be breaking below that low that we got yesterday. That was the ADP low. So this move that we've seen from 150 is continuing. That's looking very dead cattish now. The fact that we broke 147, okay, that was a bit of an impulse move. Got through the 146.80s, a level I've been watching a lot. This isn't an impulse move per se. It hasn't come on a data point or anything like that. We are getting some decent selling. I haven't checked actually to see if there's any headlines behind that. Just going to double check. No, nothing huge that sticks out on the news front for that move. But it's yen's been under the cosh going in, you know, since this move up here, and it's continued in through month end, and it's continuing now. So I don't know. I'm not sure this is either Japan politics related either, because it's quite a big move for that as well. So something's going through in the yen, definitely, and that is having a bit of a drag on some of the other pairs. You know, with dollar yen coming off, you'd think euro dollar would be shooting higher, but like yesterday, it's not. We're sitting in some pretty tight ranges, and I think euro yen is putting the brakes on this one a little bit, because the dollar overall is staying pretty steady. So this is all a yen move at the moment in spades, and I'm not 100% sure what's keeping this going. You are short, Ali, at 146.70. Okay, that was a bit of a... You just got into that, didn't I assume? Because that's only just happened. So, okay, good one. You're on your way with that trade. Let's see where it goes. If we do, we've obviously got this prior low down here, which we're looking like we might be testing. We have got the 146.50 level, which has had a couple of little areas that we've seen it pull up against. So keep an eye on that. 146.30, call it, is also one of those levels that we've had touches and probes below, but we couldn't stay below there for long. So that again is a bit of a line in the sand for this move. If we're breaking below there, then we're probably going to be going down into the 145s. So this could be quite a significant move we're seeing at the moment in this one. So just take care. But as I say, keep an eye on those crosses, because this is all yen related at the moment. Okay, and as I say, that's going to put a bit of a drag on the others. Aussie dollar, for example, keeps nudging up. We can't get up to this level again. We're pulling up short in the 20s. We've had 4 goes, or 3 goes at that. 1, 2, 3. And if dollar's coming off, then this one should be going up, but it's not. So as I say, that's got some drag in it from Aussie yen, what's going across there. But as I say, 3 goes up here, and we still can't get through, can't even touch that level, 66.36. So it still looks bullish in this phase, but it can't take out that lower high off of this prior high. So that's a bit of a worry. Could mean if we do continue to fail up here, we're going to see it pull back again, and then we need to see whether it goes on to make a new low. As I said, looking at euro dollar, we keep turning around this 117.50 level. It's washing out as a level, but it's still quite a significant pivot point until we get a decent hold, be it above or below. And we tried a bit yesterday. We were below. Now we're back above, trying to stay above, until we get something more significant. Something a bit more looking like this, where we keep holding it, or like this, where we can't get through. It's really a bit of a coin toss. But a bit like Aussie dollar, where we've got these lower highs. Okay, this is the one to beat in this phase here. So we've got to take out that high to try and turn around this downtrend that we're seeing here. But this uptrend that we've got going on here is valid at the moment. But this is really the crunch point. If we're breaking there, we've probably got a good chance of trying to take back this downtrend. But if we fail here, then we've got every chance of, let me get my little pencil out. We've got every chance of doing something like that. Oh, come on, I'm mucking it all up now. There we go. We've got a chance of doing something like that. And if we go on to make a new low, then this trend is becoming something that's a bit more. But context is also needed. Look at it in the bigger picture. We're still in a massive uptrend for the year. And that doesn't look like turning this. Anything like that is just another minor pullback. And, you know, if we're down, not even testing down near the 15s yet. So, yeah, it's a long way to go. So take things in context. Intraday, yeah, we can get some potential moves. But in the wider picture, doing this still doesn't mean that we're going to be collapsing all the way down to 114s or 113s or anything like that. So context is always needed. Let's just get rid of that. Boom. Dollar CAD, another one. And we were joking in our chat room about analysis earlier, you know, about pairs. They still can't do this and still can't do that. Dollar CAD still can't break up through this prior high. We've had a test almost to the pip yesterday. It's failed and then it's pulled back again. Now, what it does down here is looking important again. If we can hold this 29.30 area like it did yesterday off that high attempt, it keeps this upside in play. But now we can't get even through the bottom of the zone. So this is all, the whole of this is just too tight a range to stay in for long. You've only got to look at prior price history to know we can't stay in tight ranges for very long. So this will be going somewhere at some point shortly. If it continues to hold this 30s level, then it builds a case to see a break up through that 58 level. And that's something I'm potentially looking at for a break trade, to play a bit short term and to add some into my core long position that I'm still holding. So if we do get a break there, though, again, context is needed. There's not far to go before we run into the next area of traffic. 139, 70, 80 is a bit of a historical level going way back. And then, of course, we've got the 140 and the 38.2 at 140.18. So breaking above 58, 60, you know, there's some traffic in the way, some big traffic in the way, not far above. So if I do a break trade on this one, I'm going to be taking profits or some profits pretty quickly. And I'll be very careful if we break him back under that zone again after any bounce. But yeah, this one could be setting up for a bit of a break up. No, Rick, I got cleaned out of my dollar yen, all of it on the ADP stuff. I was trying a little bit of a long into the figure, which I'm a bit silly, bit of a schoolboy. I wasn't thinking about too much risk of the ADP, so that cleaned me out. I also had my stops on my 145 longs from down here at 146.75, just below that old fib there. So yeah, that cleaned me out of everything. So I'm flat in dollar yen. I think I'm happy to stay flat for the moment until I get a better feel for what's going on here. Obviously, it looks like a big rally sell at the moment, but I'll probably leave it until after the election just to see what this move is all about, whether it's that or whether it's what's going on in the US or whatever. So I'm not sure the reasons why it's moving as much as it is. If I'm not sure, I'm less inclined to trade it until I sort of get a better idea of the picture. Ali, what do I say about gold? When every man is dog is long gold, every analysis is saying more highs in gold, then should we not be careful? So you're thinking about what the crowd speak is doing. Everyone's long gold, everyone's bullish gold. Should we be careful? Long story short, Ali, it doesn't matter what people say. Yes, you've got people positioning. Yes, everyone's screaming gold because we're in a massive uptrend, but it shouldn't matter. What people say shouldn't matter. All that matters is how you analyze it and what you think. I don't care whether gold's going down $500 or up $500. Okay, me sitting here now and going, I think gold's going here, there, anywhere is irrelevant. What is relevant is what the price is doing. And as I've been showing for months and months when I look at gold, all you can do, all you should be doing is just trying to identify the levels. Identify the levels where the price might turn around. Identify the levels where the price may bounce on dips. Okay, now, if you've been following the show, you'll know that all these levels, what's this? This is going back just in September. All these levels I've been putting on the chart as the price progresses. Okay, this isn't ancient price history. This isn't, you know, stuff that's magic that I've pulled out of thin air. All I've done is just looked at places where the price might do something. Okay, and then from that, you end up with a load of levels. Now, it doesn't mean you're going to trade all those levels, but what you then do is you, through the price action reacting, you can then identify which levels are potentially becoming stronger. That's why I've changed all these levels that were pink to white, because these are now the levels where they may be the strongest. So from having 10, 15, 20 pink lines, I've got 1, 2, 3, 4, 5. Oh, 1, 2, 3, 4. I can't even count. I've got 4 levels that are now potentially stronger. And look what happened. We got a dip off this high, and it pretty much held on to that level, pretty close, a couple of bucks. That's good enough. Okay, that's what you want to be doing. And the same thing's happening here. We got a level here. This level here, 38, 54, 55 could be a level because we're getting plenty of action. It's holding, it's holding, it's holding. It's not got as good a price action here where you have a touch, pull back, a touch, and then a break, and then a hold. So it's not as strong as this, but it's building into something. So I don't care what my view of gold is, whether anyone's calling for 4,000 or people are calling for 3,000. It doesn't matter. All that matters is how you analyze it and how you pick a trade out of it. So if you want to look for longs, well, this 38, 54, 53, 55 level is somewhere to look at longs, but you don't need to do your bollocks on it. You don't need to, you know, have $50 risk on it, $50 stop, you know, 14, 15, $20 below. You're wrong. Okay, you can keep a trade nice and tight. This level here, 38.73. It might be something, it might be not. We're above it and we're trying to hold above it. If we hold above it, well, we've got a chance of going on for that high. So it's what you do with this level. Now, if this high does this, then this line becomes white, and you know you've got something significant up here. So you've got something to lean on. So if you do want to short it, you know, you've got the price evidence to show that's where you short it. Doesn't mean it's not going to go up to 4,000. But for now, over the course of however many days or hours, we can't get through this level. So that gives you something to trade. Doesn't matter your bias. Forget your bias. Forget I think this is going to happen. I think that's going to happen. Trade what the price does. Learn how to identify levels. And then maybe I'll turn this level white because it's become strong. So now I've got, oh, I can't even do that. Let's go into that. So I make that white because this price action says this is a significant level. It's more significant than this. It's potentially more significant than this. So now all of a sudden I've got 1, 2, 3, 4, 5 levels that I can potentially trade over a longer period. Because these are the levels. If you do this exercise, okay, let's say this high here, let's just take off of that if I can. Let's say this high here is the high forever. Okay, it's a high that's going to last 15 years. Yeah, you can see the price going all the way down there. Well, from that point onwards, all your tech is going to come off that level. You're going to draw a fib from the low up to that high there. And then if you get a move down here, you're going to draw a fib like that. Okay, and then, you know, sometime later the price does this and blah, 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 blah. And now you're going to draw a trend line from that high all the way down there like that. Okay. So after the event, you're going to be looking at the tech for months and weeks ahead. Okay. If that's a major top. Well, if you follow the price action, don't worry about trading here. You could have identified that in the first instance, just based on what the price does. Okay, so you can trade what could be a 20-year high, a forever high, if you do the right exercises at the moment, at the time during that. Forget about what happens 6 months later and, oh yeah, that was the biggest high for 20 years. Doesn't matter. That's all after the event. Learn to do the during the event. Give it all that. So that's why I do all this price action stuff. Yeah, you can have fib extensions and, you know, people who are marking this and marking that and, you know, trying to guess where the price is going to go. That's fine. You can carry on doing that, but you won't get better direction than what the price does during the day, during the hours, over a week, over a month. Okay, and you get this all day, every day long. If you have a trend line like that, well, you might be waiting 5 days before you get a test of that. And in the meanwhile, the price has done a ton of stuff before you even get up to that line. So that's why I do all these funny lines. That's why you can see I've got hundreds of these, all these little lines, mainly because I'm lazy and haven't pulled most of them off. But, you know, we may never get back down here again. But if we do, I've got levels that will potentially give me a trade because they're the ones I'm going to trust over the others. Okay, so forget about what your bias is. Just worry about what the price is doing. You can see what I use, Ali. Pretty simple. I use horizontals. I use fibs. I use moving averages and the odd trend line. That's it. I don't need a million things. Don't use RSIs. Don't use witchcraft, head and shoulders, any of that. But it doesn't matter what I use. It's what you use and how you use it. If you like a head and shoulders, you go ahead. It doesn't matter. I could do this. I could just get that and do that and say, right, I'm going to trade when the price gets to that line. It doesn't mean anything. It's just a squiggle. But if I see the price go down to my squiggle, I can put a trade there, maybe with a little bit of risk. And if it bounces off my squiggle, I make money. If it doesn't, I get stopped out. It doesn't matter what you use. All that matters is how you trade it. So, you know, pick your own tech, find out what works for you, what you're comfortable with, and go ahead with it. But what I would say to every single trader is start your learning on a blank chart and just do the exercise of finding where the levels are, finding what levels are strong, what levels are weak, identify levels. Then if you've got 10, 15 levels, score them. Say, right, well, I like this one, but it's a bit weak, or I like this one because it's stronger. So I won't trade this one, I'll trade this one. And just do the exercise. It's pretty simple. It's not rocket science. You just find places where the price has stopped and touched multiple times and whatever. And you just build yourself a picture. And it doesn't matter whether the price respects it or not. You just have to learn what you want to do against those lines. So I would tell all traders to practice this. Get a clean chart. Doesn't matter. You can do it on any asset you like. It does not matter. You may never have traded Chinese 10-year yields before or Chinese bonds. All right, that's not a good example. Let's move on to another one. Doesn't matter. You could still draw lines on it. You could still trade it. Doesn't matter what the asset is. It's the exercise that's the same over and over. Rick says a comment from Paulie. I have lines from when Moses crossed the desert. Yeah, absolutely. Absolutely. I have lines that stay on my charts for years and years and years. Dollar yen, euro dollar. I've got 5 lines that I've been trading for the last, 15 years. In here, 1, 2, 3, 4, 5. Okay, because it's places where we have a lot of price action against it. And when we haven't been there for a while, we can get decent reactions from it. You know, you'd all remember my 115 when we were all down here and everyone's calling parity and we're moving up. I said, it doesn't matter. 115 is the big level. Doesn't matter what we do at 113, 114, 111. 115 is the big level. 112 is the big level. 110, 107, 105. You know, 5 lines and I could trade and make money off of those. Touch wood. Okay, don't need anything else. Just identifying the stuff, and you have these charts that have your key massive lines on them, massive levels on them, and it may take, where we do 2021 was the last time we traded at 115. You had to wait 4 years before you traded it again, and if you shorted it, yes, you would have had a bit of a spike here, but if you shorted into there, then you could have got 100 pips out of it, 150 pips out of it. Isn't that what we're here for? Right, anything else you guys want to talk about? Because I've been prattling on, as I often like to do. Adi says, Japanese strength is due to the Tenkan release. Rate hike chances solidified. Yes, I agree with that. I disagree with the size of the move. This is not... Let's go into that. This, which is now what? 330 pips, is not a 25 pip hike. Okay, now yes, the market could be getting a little bit hawkish and saying, well, maybe we're going to get a series of hikes. We know the BOJ's MO though, and that is to keep things slow and steady. But 350 pips, 330 pips for a 25 pip hike, that's a lot. That's a lot. Okay, we didn't get that on the last hike. So yeah, I'm not saying you're wrong, but I'm just saying it's a big move for just a 25 pip hike in the grand scheme of things. Right, anything else for anything else? What else are we looking at? I'm going to have a quick look at Aussie Kiwi, which is looking like it wants to have one of its biggest pullbacks really for the last couple of months. The last time we got a pullback this significant was here, and just eyeballing it, this looks to be a little bit bigger. It has been in such a strong uptrend though, you could expect to get, you know, fairly steep pullbacks when they happen. The bigger and faster they go up, the harder they can fall. I'm a bit gutted we didn't get up to this fib up here, because I would have liked to maybe given that as a tap, try and get some of the money back that I was shorting it all the way up. But that's not to be. So this still might be in a bit of pullback mode. So yeah, I haven't got any levels in play. I've been ignoring it. So we have got a bit of something in there, potentially. Not overly clear, but, you know, we've had some touches in there. So we've got that moving average creeping up as well. So yeah, what's that? 113, 25, 26. That could be an area where if we bounce from that, it will be just a trend refresh, and then maybe you can go on to the highs again. No, I don't know about that, Ali. Liz, you want to look at Kiwi CAD? Cool. You do like the old CAD crosses, don't you? Have I even got that one on it? Kiwi CAD. Let's have. Here's a guess. When was the last time I looked at this one? Ages ago. Let's see what's going on in Kiwi CAD. So you're looking at long. So you're playing Aussie CAD and you're playing Kiwi CAD. So you're bullish on both. So what are you doing in this? Long from where? We've had looking like we've got a bit of a break up through this 81, 15, 20 area. Incorporate the fib in as well. Again, the level we've had support against, resistance against, resistance against. Now we're breaking it. So this is your pivot area here. If we're holding above here, then longs look good. If we're breaking back below, then longs aren't looking so good, and maybe the short side is where you want to be playing it. But yeah, if it holds this break, let's see what it's like on the shorter time frame. Yeah, it's got a chance to hold it. It's had half a chance, that little candle there. If you get a retest and you want to go long, that's the area to go long. You don't, you know, probably under 81, that's where you're going to be wrong. So again, another fairly tight trade if you want to go for something like that, but Liz, let me know what you're looking at. You're saying long. Where are you long? Are you in? Are you waiting? Are you planning? If you're long, where you're long from? What you're doing? Where's your profit? Where you're looking to take profit? I would say just eyeballing this. You want to be maybe looking somewhere around there. It's not overly clean, but somewhere around between there and what's that, 68, 70 is an area where if I was long, I'll be looking to take profit. Maybe you could have a little look around there as a place to take profit, or where we look to be running into trouble. So again, all I'm doing is just picking these little points out, and we'll see if that happens. Not yet. You're not long yet. Okay, so if I was trading this, I'll be looking at a long round about there. Stop below 81, the figure. Nice and tight. Don't need to give it much. And if it does go, well, you could be going back up to the 82s, something like that. But you know your level's in the way of that one. Right. If there's nothing else going on, let's have a quick look at what data we're not getting today. Obviously, with the shutdown, I don't think there's a lot out. Anyway, we've got Challenger layoffs. Just keep an eye on that. They have been running pretty hot over the last few months. Durables is obviously off the cards, as is factory orders. Well, all part of the same report. These will be the durable revisions. So that's off the cards. We will probably get the Fed head speaking, Logan. We've heard Goolsbeast, he seems to be out every day. And even old Gimpos from the ECB is speaking again. That's a new one. So yeah, Challenger layoffs, 12:30 UK time is the only data we're getting. Michael, I'll have a look at dollar NOK in the chat room for you, mate. But we'll call it a day there if you want. I might see if I can drag in some strays into the show, some guests while Kay's off. Maybe latter part of the week or early next week. I'll see who's bored and wants to come on the show. Right, have a great day, everybody. Catch you later.